Hi, everybody. Thank you so much for coming. My name is Miguel Centeno. I'm the director of the Global Systemic Risk Research, whatever it's called. And it's my great pleasure to introduce Andrew Love. He actually needs no introduction. Let me just read the little introduction that's on this fabulous book. Actually, this is an economics book you actually want to read. And it says, Andrew W. Lowe is the Charles E. and Susan T. Harris Professor at the MIT Sloan School of Management and the Director of the MIT Laboratory for Financial Engineering. He is the author of Hedge Funds, that's a nice title, and the co-author of The New Random Walk Down Wall Street and The Econometrics of Financial Markets, all by Princeton University Press, as is this Adaptive Markets. He is also the founder of the Alpha Simplex Group, a quantitative investment management company based in Cambridge, Massachusetts. And with that, it's my great pleasure, Andrew Love. Thank you so much, Andrew.
So I'd like to, is this on? Yeah, thanks. I'd like to start by thanking Miguel for that introduction and for inviting me here to the Princeton Institute for International and Regional Studies in their Global Systemic Risk program. It's a particular pleasure for me to be here because I understand that this center is really an interdisciplinary one, drawing from various different disciplines and across the institute, across the university. And the topic that I'm going to talk about today is also interdisciplinary. Now, I'm not interdisciplinary by training or trade, but over the course of the last few years, I've started to try to understand this concept called systemic risk, which I think many of you understand well from your field. I've run into a lot of different disciplines that I think have some useful things to contribute. So I'm hoping to get your help in thinking about the kind of issues that we're dealing with in the financial system, and I'll be taking you through some of those issues over the course of the next half hour or so. I want to begin with technology, because that really seems to be the core of a lot of the challenges that we're facing in the financial system. And I'm sure that all of you are familiar with Moore's Law, the idea that we've been making pretty regular progress in doubling the number of transistors we can fit on a single chip. And although some of the physicists at MIT and elsewhere tell me that we're running up against a limit for Moore's Law, so far it doesn't seem like there's any end in sight. And so you can imagine that in addition to having an impact on the technology field, Moore's Law should also have an impact on the financial system. And it's not surprising that if you think about the way that financial transactions were conducted, that's changed a lot over the course of the last few hundred years. Beginning in May of 1792 with the Buttonwood Agreement that established the New York Stock Exchange, we now know that trading has become much more technologically sophisticated. As of maybe 10 or 20 years ago, if you visited the New York Stock Exchange, the floor, you would actually see lots of people crowding around these trading pits, engaging in all sorts of transactions. And if you went to that floor today, well, first of all, the floor would be about half the size of what it was just a few years ago. And the majority of trading volume occurs not on the floor, but here, in these server racks. So you can imagine that Moore's Law should have an impact on finance. There should be a financial Moore's Law, and actually, not surprisingly, there is. So I'm going to show you the financial version of Moore's Law, which is the trading volume in exchange-listed options and futures contracts over the course of the last few decades. That's in the red line, and if you plot it on a logarithmic scale, you get this line over here, which says that roughly we're doubling in trading volume about once every 8 years. Not quite the same as Moore's Law, but definitely increasing at an exponential rate. And of course, all of this has to do with this particular graph. Does anybody recognize this? Does this look familiar? Anybody?
It's a human population.
Very good. So this is the population of Homo sapiens from 10,000 BC to the present. And when you look at that, you see that there are at least 3 or 4 distinct periods in our evolutionary history. There's that flat part of the curve, which is the Stone Age. The upward sloping part after that, which is the Iron Age. Then the more steeply sloped part, which is the Industrial Age. And over the course of the last century or so, an even more steeply sloped period, which some people call the Digital Age or the Information Age. In fact, that's quite an astonishing period. If you look at the last 100 years, from 1900, there were about 1.5 billion people walking the planet. As of this year, the estimate is about 7.6 billion people. So in the space of about 100 years, we've actually increased our population by a factor of 5. That's an astonishing achievement for any species, let alone Homo sapiens. How do we do this? And the answer is technology. Sorts of technology: agricultural technology, medical technology, manufacturing technology, information technology, and financial technology. The problem with all of these technological innovations is that technology can have unintended consequences, things like pollution, environmental impact of human activity, financial crises. And so we have to think carefully about how our technology interacts with human behavior. As clever as Homo sapiens are, we're also the curious George of the animal species. We get into all sorts of trouble, and the problem is there's no man in the yellow hat to bail us out. And so I want to talk a little bit about that interaction between Moore's law and what we all know as Murphy's law. The fact that whatever can go wrong will go wrong, and the technological version of it, whatever will go wrong bigger, faster, and much more difficult to prevent. And in the financial system, you can see this happening before our very eyes. Capital requirements are harder to implement because now it's even hard to define what we mean by leverage and certain kinds of exposures to these kind of shocks. New risks for financial stability have been created. I'll show you a few examples in a few minutes. And fairness and privacy issues have emerged along the way. And a lot of this has to do with a mismatch between the speed of our ability to act and react and the pace at which financial innovation is occurring. And so this idea about complexity increasing, but the fact that human cognition has not been able to keep up is really at the core of a lot of the challenges that I'm going to talk about today. So I'm going to give you a few examples, but ultimately what I'm hoping to do is to illustrate to you what we're dealing with now and then try to come up with some solutions that will actually cut across these various different fields. So let me start with a very simple example of Murphy's Law, something that has occurred since the financial crisis. Now, the financial crisis is probably the best example, the most important example, but post-financial crisis, we've got a new set of issues that we're dealing with. And what I want to tell you about are flash crashes. On May 6, 2010, something unusual happened in the stock market. Now, those of you who aren't in the financial industry, you probably would not really know about any of these issues because what happened occurred over a 15-minute interval. And if you happen to go to the bathroom or get up and stretch your legs and miss that 15 minutes, it's as if nothing had happened. But actually, a lot occurred. What happened during 15 minutes in the afternoon is that the prices of a number of stocks went from their normal values down to pennies. A few other stocks went from their normal values to a couple of $100,000 a share. And it happened with a blink of an eye. And then, as if magically nothing happened afterwards, all the prices actually went back to their normal values. Of course, a lot of damage occurred because there were a number of people and institutions that had these so-called stop-loss policies. A stop-loss policy tells your broker that if your stock goes down by more than $10 a share or more than 10%, sell, close out my position. And during that day, stocks went down by 95%, 80%, and it was just tremendously tumultuous. Now, here's an example. So Accenture was and is a very large management consulting company, part of the Fortune 100, one of the largest companies in the world. They employed 190,000 people back in 2010. Their revenues for 2010 was about $23 billion. And prior to the afternoon of May 6, 2010, they were trading at about $40 a share. So this is the price of Accenture from 2:45 p.m. to 2:55 p.m. Starts out at $40 a share, and it goes down to a few pennies for approximately 5 minutes. And then it goes right back up to $40 a share. Now, you might look at that and say, gee, no harm, no foul, but many people actually traded during this period, and they were locked into some very, very significant losses, and after the fact, they weren't made whole by the exchange. The exchange canceled all trades that happened greater than 60% away from the prices before the so-called flash crash. But if you had transactions that occurred at 59% away, those trades were good and not cancelable. And so tremendous losses, and this is just one stock, there are many, many stocks. So you can imagine that a lot of questions were raised, and the SEC and the CFTC did something unprecedented. They collaborated on a study that was published months after this occurrence. On September the 30th, the SEC and the CFTC issued a joint report describing what they had discovered about the flash crash. And what they discovered was supposedly the actions of one large mutual fund supposedly triggered this crash because this mutual fund was trying to hedge its exposures to the stock market. And so it had put in a sell order for 75,000 futures contracts in order to hedge that position. And the claim from the study was that this particular mutual fund actually caused the flash crash. So that's, in a way, good news. We now understand what happened, so we can just make sure that that doesn't ever happen again. The problem is that that's not exactly what happened. And it took about 3 years, but a couple of academics published a paper. They had sifted through the data, trade by trade, on that fateful afternoon. And what they discovered was, yes, indeed, this mutual fund did put in an order that ultimately ended up being 75,000 contracts. But the vast majority of that order was actually transacted after the price drop. So they weren't the ones who did it. Well, if they weren't the ones who did it, then who did? So a couple years after that, the Justice Department filed a suit against a trader who apparently was trading from the basement of his parents' flat in a suburb of London and had supposedly triggered the flash crash. And they filed extradition request, and ultimately this trader was actually extradited, stood trial in Chicago, pled guilty, and in November was sentenced to restitution. He had to disgorge his profits, pay a penalty, and was under house arrest for a period of time. And was barred from the financial industry. So that suggests that now, okay, good, we got the cause. Which, by the way, for those of you who are thinking about this, gee, can one person really bring down the financial markets, for 15 minutes? That seems kind of shocking. And so there are a number of skeptics who said, no, this is not the reason. And of course, the last iteration, which was published a few months ago, another academic study, showed that actually it doesn't look like he was the culprit. What looks like may have happened is something called cross-market arbitrage. It's that selling between different markets had become much more important than people realized. And so during the afternoon of May 6, 2010, some of those cross-market arbitrage channels were closed, which made any small trade have much, much larger impact than normal. The bottom line is that it's been 7 years since the flash crash. The flash crash occurred over a finite period of time. It affected a finite period of stocks with a finite number of participants in the marketplace. And 7 years later, we still don't know what happened. We don't know what caused it. We don't know what we can do to prevent it. And what's worse, since that time, there have been other flash crashes. So on October the 15th, 2014, we had a treasury market flash crash where the price spiked down, went right back up. March 18th, 2015, currency flash crash. August 24th, 2015, a flash crash in ETFs. This is a very narrow segment of the US stock market, but somehow that particular subset was singled out for these kind of flash crashes. The SEC filed a report, and the report basically was inconclusive. We don't yet know why ETFs suffered flash crashes then, and another US dollar pound sterling flash crash in October of last year, and just this year we've had 2 flash crashes in some cryptocurrencies, Ethereum and Bitcoin. This is an ongoing problem, and this is just one of a number of problems that we're facing in financial markets. And we don't know what's going on. No one person seems to know. There are lots of conjectures, but the best guess that I've heard is that the system has gotten more complicated, and we don't yet know how these various different parts are working together or sometimes against each other in order to create these instabilities. So we need a new approach. That's the starting point for what I'd like to tell you about today. And the question is, what is that approach going to look like? Now, in one of the articles that I proposed in preparation for this lecture, an article that Simon Levitt and I published last year, we're proposing to look at financial markets as an ecosystem, because that's really what it is. It's not a mechanistic process that you can easily tease apart through some simple mathematical formulas. It's much more organic. And if you look at it from that perspective, it changes the way you think about how to deal with some of these challenges. So we don't have a lot of answers, but we have a research agenda that we highlight in this article, and we urge all of you to take a look at it, because we need your help. We need the help of people from various different disciplines. So I'm going to be talking a bit about that later on, but I want to start with the starting point of where things are today in terms of how we deal with these markets, how we regulate them. And that has to do with a particular financial theory that some of you may have come across called the efficient markets hypothesis. Turns out that the efficient markets hypothesis is at the cornerstone of what a lot of regulation, particularly in the financial markets, are constructed with. A few years ago, a law professor, Henry who at one point also was an SEC official, he wrote an article titled Efficient Markets and the Law, Predictable Past and an Uncertain Future. And in this article, he highlights the role that this idea that prices fully reflect all available information, that investors are rational, market prices work well in terms of reflecting the underlying fundamental values of the assets. He highlighted how that idea, and a very powerful one at that, is really instilled in various elements of the law. So for example, the SEC's regulations for disclosure, the fact that when you invest in something, you get this prospectus that's like 80 pages long with really tiny fine print. You have to read it all because it tells you all of the various different ways you can lose your money. That disclosure regulation is predicated on the fact that as long as you provide investors with information, markets will do the right thing. Prices will fully reflect that information. Securities fraud, the idea that you have to provide investors with information in a timely fashion, and if you hide things from investors, you can be sued. That's also based upon efficient markets. How you calculate damages in case there are securities fraud cases, all of these aspects of the law really take for granted that markets work reasonably well. The last point, the idea that central banks engage in macroeconomic policy prior to the financial crisis using these so-called dynamic stochastic general equilibrium models. These models, in their most basic form, prior to the crisis, didn't even include the financial sector as part of it, because the assumption was that the financial sector works well, and that's not really the focus of monetary policy and the real side of the economy. So the question that I want to start with here is, what if markets aren't efficient? What if there are frictions or other behavioral anomalies that ultimately chip away at this foundation on which all of these regulations are based? We're going to run into problems. And so this is where we need a new paradigm. And Miguel was kind enough to point out the book that I just published. The reason I wrote the book was to provide that kind of perspective. It looks at markets from a somewhat different lens. The efficient markets hypothesis is not wrong. It's a very powerful idea, and it works a lot of the time, but it doesn't work all the time. It's incomplete. And there are aspects that you have to deal with, particularly when it comes to financial regulation, that require you to think about alternatives. And so the notion of adaptive markets is what I described in the book. And the basic principles are listed here, but it's the same principles that apply to virtually any ecosystem. The fact is that you've got a population of different species that are competing with each other. They innovate, mutate, compete, adapt, and ultimately it's those dynamics that you really need to understand in order to manage the system. The evolutionary biologist Theodosius Dobzhansky famously said that nothing makes sense in biology except in the light of evolution. So rather immodestly, I'm going to steal that quote and say that nothing makes sense in financial markets except in light of the adaptive markets hypothesis. We have to think about an alternative way of how people interact with each other in order to understand these kind of financial crises. So I want to start with a couple of examples and then transition to what we can do about the situation and then open it up for discussion. I'll start with risk perception. And I'll begin with a particular example that I give to all of my MBA students at the beginning of my introductory finance course to try to elicit from them a sense of their risk preferences and how they balance risk versus reward. So the way that I do that is by showing my students 4 different financial investments. I don't tell them what they are. I don't even tell them over what time period they span. I just show them the following 4 time series of the cumulative performance of a $1 investment in each of these 4 assets. And I ask them to pick one of these 4 to invest your entire wealth. You can only have one of these 4. You can't mix and match. And the question is, which would you pick? Now, they're very different. The green line turns $1 into $2 over this unspecified period. Not very rewarding, but also not very risky. The red line turns $1 into about $5, more rewarding, but more volatility. The blue line is even more rewarding and even more volatile, and the black line is somewhere in the middle. And so this is a question about your personal risk preferences. And if you've seen this before, don't give it away to the rest of the audience. How many of you would pick the green line to invest your wealth? Anybody? 1 or 2 people, okay. How about the red line? How many people will pick the red line? Wow, only 1 person, 2? Okay. I want you to remember this because once I tell you what this asset is, a number of you are going to have to go back and rethink your portfolios. All right? How about the blue line? How many people would pick the blue line? Okay, those are the hedge fund managers of the future. And the black line? Yeah, so that's by far the most popular, presumably because it's got the best trade-off between risk and reward. Well, let me tell you what these investments are. So the time period is from 1990 to 2008. And the investments are, well, the green line is US Treasury bills. Safest asset in the world, but not particularly rewarding. You don't earn a lot of return. And so since 2008, you basically have made next to nothing in that investment. So it's safe, but for retirement purposes, probably not a good idea. What about the red line? Well, the red line is the S&P 500. More volatile, but quite a bit riskier. And most of you have that in your portfolio, so if you didn't pick it, you may want to rethink your asset allocation. The blue line is the single stock Pfizer, the pharmaceutical company. Much more risky, but much more rewarding. And finally, the black line, those are the returns to the Fairfield Century Fund, which is a private fund that was the feeder fund for the Bernie Madoff Ponzi scheme. That's why I had to stop it in 2008. Now you know how the Ponzi scheme got as big as it did. Now, this is human nature. We're all drawn to investments. Like a moth to a flame, we're drawn to investments that have high return, low risk. So in finance, we have a quantity that captures that. It's called the Sharpe ratio. It's literally the ratio of the average return divided by the standard deviation of return, the volatility. And we just love high Sharpe ratio assets. That's part of our makeup. And so when you're thinking about various different kinds of investments, you will see investors that will flock to these investments. And the theory goes, efficient markets would say, that in equilibrium, these things should equilibrate. Things that have high Sharpe ratios, as you put more money into it, Sharpe ratio will eventually come down, and that will allow you to invest in other assets over time. Well, we'll see. Because another aspect of how we make decisions is how we perceive risk. So now I want to give you an example of risk perception. And to do this, I want to bring you to a very old article that was written in 1975 by an economist at the University of Chicago by the name of Sam Peltzman. This article has an incredibly boring sounding title. The Effects of Automobile Safety Regulation. Yawn. You know, what could be more boring than that? But it's actually anything but boring. This is one of the most controversial articles published in this journal, and over the course of the next several decades, launched literally hundreds of other studies to try to deal with its implications. So let me tell you what Peltzman did. In those days, the automobile industry was required to install a number of different safety devices. Things like safety belts, lap belts, shoulder belts, padded steering dashboards, collapsible steering columns, safety glass. And each time the government mandated that these safety devices be installed, it obviously cost the automakers a lot of money, and they had to pass on these costs to the consumers. And so Peltzman asked a very simple question: given all of these innovations and how costly they are, do they work? Do we save lives? How many lives? Is it worth it? Is there reasonable cost benefit? And so he went out and measured. And what he found was absolutely shocking. He found that there were no benefits. There were no lives saved. Now, that's not exactly what he found. What he found in the data was that once these safety installations occurred, the number of traffic deaths from highway accidents declined. And then after a couple of years, it went right back up to where it was before. This happened in several cases. There was only one case where the number of deaths, the number of automobile occupant deaths went down. And it seemed to have gone down permanently. And the reason I state it in that way is because in that case, it was offset by the number of pedestrian deaths that increased afterwards. So Peltzman came to the conclusion that once these safety devices were installed and drivers felt safer, they drove faster and more recklessly, offsetting the benefits of these devices. His argument is that if you want people to drive safe, the last thing you should do is to install these safety devices. If you want them to drive safer, you should take them all away and install sharp spikes on the dashboards pointing at the drivers. Then they'll be very, very safe. People adapt. Now, once he published this very, very controversial study, lots of people came to challenge and said, well, wait a minute, you didn't control for all sorts of confounding effects. For example, the kind of driving. Was it commuting, or was it vacation driving? Was it rural or urban? What about the education of the driver? What about the nature of the occasion of the driving? And so many studies were launched to try to either confirm or refute the Peltzman effect. That's what it's called. And some of them supported Peltzman, some of them contradicted his findings. And it wasn't until one study was published in 2007 that was able to control for all of these confounding effects that this issue was finally resolved, at least in my opinion, to my satisfaction. Can anybody guess what that particular setting was? So these two economists, they actually found a specific situation where all of these other factors were properly controlled for. And so the only thing that mattered was getting to your destination a little bit sooner. Would that be? Taxis? No. Actually, it would be interesting to do the study now because we have data from Uber, but back in 2007, we didn't have much data. So we couldn't get that kind of data. But you're right, that would be an interesting experiment. It turns out that the context was NASCAR. So NASCAR has a real problem on its hands because every time it installs a safety device in its race cars, titanium reinforced struts or firmer roll cages, what happens is that the number of accidents and deaths, they don't stay the same. They actually go up. They increase. And so this seems to confirm the Peltzman effect. When you control for all the other factors, and the only thing that matters is getting to your destination a few seconds earlier, you will push the car to its limits and beyond. Life is filled with these risk-reward trade-offs, as we know from ecologists and evolutionary biologists. And suppose that in one of these situations, the reward stays the same, but your risk goes down. In other words, your Sharpe ratio has increased. If that happens, what are you likely to do? You'll want more of that asset. So if I tell you you can cut your commute time in half, you might actually want to take me up on that by driving a little bit faster and maybe a little bit more recklessly, albeit in a safer car. And so the problem comes when our risk perception differs from risk reality. And this is something that psychologists, particularly here at Princeton, Daniel Kahneman and his collaborators, have documented over many, many years. When we experience a sequence of gains, after a while, risk doesn't seem to matter to us anymore. There is no risk. Why? Because we haven't had an accident in all these years. Why do we need to wear seatbelts? And after a single bad loss, well, all of a sudden, risk is right there, front and center. We actually experience it, so it must be really huge. And this kind of behavioral perspective can easily generate the kind of swings in the pendulum from feast to famine, fear and greed, back and forth. And this has particular relevance today because here's where we are today. So this is a plot of the VIX index, which estimates a forward-looking measure of what the stock market's risk perception is. It uses options on the S&P 500 to see what people think the volatility of the market is. Typically, the U.S. stock market, yes?
Let me stop you a minute. That seems, the NASCAR testing is remarkably bad testing because it's the most likely case for Peltzman's hypothesis. That is, you only care about when you get there.
Right.
If the, and then you'd expect you would compensate. But if accidents are caused by lack of attention,
Sure.
I have a car that focuses my attention better. It may have an effect on my driving as,
Sure.
as a careless driver, but not on the NASCAR person. So it seems
That's
to me
right.
That's a most likely case for Peltzman.
Well, the way that the authors, I don't want to speak for the authors since I haven't talked to them about this, but if I were to make their case, the way that I would put it is that it's not necessarily the best case for Peltzman. It is the most controlled case in the sense that I've basically controlled for all of these other confounding factors.
But you control for the wrong things.
Well, I
You control for what's affected by the quality of the car, and that's what you shouldn't be controlling. You're controlling for an explanatory variable.
well,
Which could be.
so you're right that if I had other confounding factors, I would change the conclusions, and there may be other factors in our day-to-day driving that would change that outcome. But this does demonstrate that the Peltzman effect does exist, right? In that context, it does exist.
In that context.
And NASCAR, by the way, has a real problem on its hands because the reason that it engaged with these two economists was to try to figure out what to do. They have a real problem in the sense that they want their drivers to be safer, but they do not want to be encouraging them to take these crazy
But
risks.
this is the context in which one could be most likely cases.
Yes.
So proving something is true in a most likely case does not generalize the finding as possible.
It doesn't generalize it to what you will do when you get in your car, right? Yes. But people would argue neither does Peltzman's article because Peltzman didn't control for all of these other factors either, right? Okay, so where does that bring us? Well, that brings us to today, where this measure of risk in the stock market is at a near all-time low. Where we are right now, where we're sitting, is a stock market that's doing really well, and volatility is really low. So if you believe that people do adapt to changing risk perception, and this tells us where we perceive risk to be today, what is that telling you about the kind of leverage and risk exposures people are taking right now? It's probably pretty high. And what that means is that if and when we have some kind of an event, we're likely to see a pretty strong reaction because now all of us are involved in this market. We have much more at stake because we're now more invested in the same kinds of assets. And so this is a problem. So now, let me turn from the individual to an institution and talk about a problem that economists and policymakers have been struggling with for quite some time, which is too big to fail. On January the 16th, 2009, Bank of America, in the aftermath of the financial crisis, required a second injection of capital, another bailout from the federal government, to the tune of about $20 billion. $20 billion on January the 16th, 2009, plus a federal guarantee for another $118 billion of assets. After the first bailout of $25 billion in the fall of 2008, and 2 months later, they would call another $5.2 billion from AIG. And of course, AIG was only able to do that because it got bailed out by the federal government beforehand. So clearly, this was a big problem. And why did we do this? Why did we bail out Bank of America? Well, it's because they're big. They're too big to fail. It would have been really bad if Bank of America failed, given how many people do banking at Bank of America. I dare say that most people in this room have accounts at Bank of America. And so Bank of America was deemed too big to fail, and that's why we did it. How big were they? Well, in 2005, so several years before the financial crisis, Bank of America had total revenues of about $57 billion. Their asset base was about $1.3 trillion. They had about $500 billion in loans and leases, and about $630 billion in depositor money, and they employed about 175,000 people. They were big, clearly. So you would think that with the financial crisis, with the bailout, we learned our lesson, right? And now Bank of America is not nearly so big because we decided that we didn't want to have another too big to fail situation. So here's Bank of America 2016. Every single metric is substantially higher than where it was. $83 billion in revenues, $2 trillion in assets, $1.3 trillion in deposits, and 200,000 people employed now. And this is true at all of the top banks. They're bigger now than they were before. Now, it turns out that this has been going on for a while. This is not new to the financial crisis. In the fall of 2006, an article was published by Hubert Janicki and Ed Prescott looking at the size distribution of US banks. And what he showed is that, first of all, the total number of independent banks have been declining for decades, from the 1960s all the way to 2005 when their data set ends. So these are the number of independent banks, monotonically declining over time. The second two figures that they have were even more instructive. Here, figure 2 on the left shows the concentration, the market share of the 10 largest banks. And that's what's shown in the solid black line here. And you can see that except for a decade between the 1980s and 90s, it's been going up virtually vertically. The biggest banks are getting bigger and bigger. Now, I want you to keep in mind this little non-monotonicity here. I'm going to come back to that. This was the S&L crisis. A number of really big banks failed in the 1980s and 90s, and that's what caused this kind of a dip. But apart from that, straight up, and if you take a look at the right-hand graph, that's the size distribution in logs of bank assets, and you can see that they're getting bigger over time. Size matters, clearly. And not surprisingly, it matters in lots of different contexts, not the least of which is in biology. So this is one of my favorite illustrations across all the various different textbooks I've ever run across. This comes out of a very old biology textbook in the 1930s. It's an illustration of the various different creatures and how big they are relative to each other. And so you can see that size varies in nature. And when I presented this to Simon, he said, well, you really should read the book of a colleague of mine, John Bonner, Tyler Bonner. And in this book, Bonner describes how size is determined. Turns out that biologically, you can relate size to all sorts of things like surface area, strength, complexity, abundance, and metabolic rate. There are reasons why animals are of different sizes. So here's one of the examples, this power law that was discovered, that abundance, the number of individuals of a particular species in a particular ecosystem, is actually related to its weight by a particular power law. But interestingly, what was discovered is that the power law depends on what kind of individual you are. So this particular graph showed that there's a negative relationship for mammals, but it depends on whether you are a primary consumer mammal or a secondary consumer mammal. A secondary consumer mammal is a mammal that consumes other mammals. And it turns out that there's a difference in that power law. But there are laws nonetheless that seem to actually hold in the data. We know that there are examples of creatures that have varied in size. The dinosaurs are huge, but take dragonflies. We know that there was a time about 300 million years ago when a dragonfly was about 3 feet wide in wingspan. That was during this Permian and Carboniferous period, where it turns out that the amount of oxygen in the atmosphere was much higher than it is now. Right now, we have about 21% oxygen in the atmosphere, but 300 million years ago, that was more like 35%. And with that higher concentration of oxygen, creatures could grow bigger, particularly dragonflies. It's not that easy, though, because it turns out that during the Cretaceous and Jurassic periods, you don't see the same kind of relationship between oxygen concentration and size, and it's because a second paper pointed out that it's not just about concentration of oxygen, it's also the particular ecosystem, the predators and prey that exist. Now, how do we know that this is true? These look like theories and conjectures. Well, it turns out that you can actually change the concentration of oxygen artificially in a laboratory and raise creatures of different sizes, even today. So here's an illustration of a dragonfly that was raised in a hyper oxygenated environment. Actually, that's not really true. It's this is a model, but they did raise it, to a point that was a little bit bigger. In fact, they did this with ants, and they showed that even with very, very simple environmental changes, you can actually double the size of a carpenter ant. So clearly, size is not just a random thing. It's a function of lots of different parameters. And now getting back to too big to fail, let's think about Bank of America. Does anybody know when Bank of America got started? The founding of the Bank of America? It's an interesting story. So the Bank of America was actually created in October of 1904. But it wasn't called the Bank of America at the time. It was called, ironically, the Bank of Italy. And it was founded by this individual, an immigrant named Amedeo Giannini in San Francisco. And he created the Bank of Italy because a number of immigrants felt like they were being discriminated against by the regular banks. They didn't want to do business with immigrants, and so he created this bank to cater to immigrants. The Bank of Italy was merged in 1922 with Banca d'Italia Meridionale. And a few years later, that was combined with the Bank of America Los Angeles to create the Bank of America National Trust and Savings Association in 1928. And over the course of the ensuing decades, more and more banks and credit card companies and mortgage companies were combined with Bank of America. In fact, this is the family tree that I got off of Wikipedia. I have no idea how accurate it is, but it certainly has the household names that we think of when we think of this conglomerate. Now, why did this happen? There are reasons why Bank of America ultimately became too big to fail. And economists have come up with the usual reasons of economies of scale, central banking system, guarantees that encourage this kind of size. But one thing that we haven't looked at as much is economies of risk and the impact of diversification. So I want to talk a bit about this now and illustrate to you how a very simple model can actually give us some hints as to what we ought to be looking at. I want you to think about statistically independent businesses. And actually, let's hold off on the statistical independence part. I'm going to come back to that. Let's suppose that we have M businesses that are identical to each other. They each have a specific rate of return, mu, and they have a certain level of risk of their return, call it sigma. And they have a particular correlation of their returns, call that rho. And when rho is equal to 0, they're going to be statistically independent, but they don't have to be. Suppose we combine these M businesses together into a bigger business, a portfolio of businesses. And we ask the question, what is the Sharpe ratio of that business as compared to the Sharpe ratio of each of these individual, identical, little tiny businesses? What does that look like? In this simple case where I'm assuming that each of these businesses have identical correlation rho, you can actually calculate it very easily. The Sharpe ratio of the combined conglomerate, SRP, is simply a multiple of the individual businesses' Sharpe ratios, theta. And that multiplier is going to be a function of the number of businesses as well as how correlated they are. So the first point I want to make is when the correlation coefficient is 0, when they are independent, when they're 1 and they're perfectly correlated, then this multiplier just becomes 1. So in other words, if you combine m identical businesses that are perfectly correlated, it's basically carbon copies of the same business that go up and down together, you've done nothing to the Sharpe ratio. You may have made a bigger business, but the rate of return, the risk-reward trade-off, has not changed. So from an investor's point of view, you should be neither excited nor discouraged by that. Now, I want to go to the opposite case where rho is equal to 0. If these are independent businesses, if that rho is equal to 0, then this factor theta is the square root of m. What that says is that if you've got no correlation, then you can increase the Sharpe ratio of your business simply by adding more and more uncorrelated bets without limit. You can ramp that Sharpe ratio up as high as you like. In fact, you can get it higher than the Bernie Madoff Ponzi scheme this way, if you can find independent businesses. So this is exactly what banks did during certain periods. With certain kinds of competitive environments and with certain risks that they're facing, given the opportunity, it makes absolute economic sense, and it makes sense from all of our points of view as investors in these banks for them to become too big to fail.
Because they do it based on their perception of real.
Exactly. And investors are also in that same game. They price these securities as a function of our perception of how these risks look. And by the way, mortgage-backed securities, they actually look pretty statistically independent in the data. If you take a look at the housing market from the 1930s to the 1990s, you will not see a period where there's strong correlation of defaults among mortgages in the entire 50 United States. You might have lots of defaults in Reno, Nevada, or lots of defaults in Austin, Texas, or lots of defaults in Stockton, California. But from the 30s to the 90s, there was no period where you had defaults in all of those regions simultaneously. So from that perspective, this actually looks pretty good. Let's do a lot more of these.
Does this thought experiment, does it assume that there are no financial incentives? This is purely based on risk, right?
Yes.
So, but in many cases, there would be actually a reward.
Yes.
That substantially outweighs the risk. And
absolutely.
That makes more an economic driver
that
of
makes it even
becoming
more likely.
larger, right?
Absolutely right.
So this is only, so you're assuming that there's actually none of that.
In this case, I'm assuming none of
that
that.
is just
Absolutely right.
it's just
a risk story, right?
So it's just a component here of
Right.
financial.
And I think a pretty important one. But you're right, absolutely just a component. And if you add induced incentives
Yes.
for these kinds of actions, it gets even worse. Yeah.
This is really the same concept that's behind modern portfolio theory.
It is modern portfolio theory.
Right?
Exactly
They
right.
just
Yeah.
apply to the bank.
Right.
And of course, what we've learned is that MPT doesn't work because correlations go to 1, right?
They
Circuit
can.
drain.
Mhm.
And the same thing can happen to business models like this.
Right. Absolutely. So the fact that this is actually just standard modern portfolio theory applied to businesses means that there's no new insight here other than the fact that when you start looking at it from this perspective, you realize that there are some pretty significant incentives to grow your business until there's not. But by that time, it's a little late. You can't easily trade out of businesses the way you can trade out of securities. So in the last few minutes, I'm going to wrap up by talking about what we can do about systemic risk. And there are many things that have been suggested, and I'm certainly not going to be able to go through all of those. So I'd like to just describe the one thing that I think we can all agree on that's totally non-controversial, that is absolutely necessary to be done, regardless of whether you believe in any of the other recommendations that policymakers, academics, and other pundits have proposed. So what is the common theme that we can all agree on? Well, I think it's that we need more feedback loops. Feedback is critical. From the biological perspective, our sensory system is really important. It's important to feel pain because typically that's telling you you should stop doing something that will ultimately hurt you. And so what you really would like to do is to be able to provide more feedback loops. In fact, many government policies are designed to thwart feedback. A government guarantee, I will pay you in case you lose money, that's an anesthetic that is meant to shield you from pain. So
Negative feedback.
Negative feedback, yes, that's right. Negative feedback. We need to have self-correcting mechanisms, and we can take a page from biology, things like homeostasis, the immune system, other adaptive processes where negative feedback allows the system to reach a reasonable equilibrium. That seems to be relatively non-controversial. There are many controversies about exactly how you go about doing it, how much is enough, but the question is, how do we go about starting down this path? And I think there, we have another non-controversial answer, which is we need measurement and analytics. You can't manage what you don't measure. And up until relatively recently, we had no measures of systemic risk. We had plenty of measures of risk in the banking system, and we had the Federal Reserve, which is supposed to be monitoring systemic risk in the banking system. But the banking system is no longer the vast majority of the financial system. There are other pieces of the financial system that are outside the control of the Fed, the so-called shadow banking system. And so the first thing we need to do is to think about how to come up with measures for the entire system as a system. So there are many projects that my colleagues and I are working on. I'm going to just go through very briefly a few of them and then conclude. So one way that we're trying to come up with measures is using machine learning models for large amounts of data for consumer risk. Working with banks and the OCC, we've managed to be able to come up with simple models to predict consumer credit card defaults, mortgage defaults, and we can actually see these defaults happening probably 18 months before they start becoming a real system-wide phenomenon. And so by using these kinds of models and data, we think we can come up with early warning signs, and the OCC is actually working on developing these analytics right now. Of course, in order to do that, we need data. And at this point, a lot of financial data is actually not shared. In fact, there are a number of laws that allow companies to refuse to share their data because they're proprietary. And there's nothing wrong with that. You know, we don't force Coca-Cola to share with us the formula for its soft drink. But at the same time, we also need to deal with implications of systemic risk. It turns out we can have our cake and eat it too, in one sense, by using certain cryptographic methods for hiding data while at the same time allowing aggregate aspects of those data to be computed. We can actually do both. We can protect your privacy, but still be able to compute aggregate statistics at the same time. Third, we can start thinking about more adaptive regulation. Regulators have already begun to do that. The so-called counter-cyclical capital buffer is really meant as a kind of automatic stabilizer to ratchet up the capital requirements during good times and ratchet them down during bad times. They're not quite adaptive to the degree that I think is necessary, so we need to work on that, but that's a start. Thinking about the legal system as a piece of software and managing the complexity of that software is another way for us to deal with this kind of growing complexity. And there's a paper that we've written using network analysis to do that, applying network analysis on the law and on the corpus of regulation. And the last two really are meant to try to capture the somewhat touchy-feely stuff that quantitative methods usually aren't very good with. One is the culture of the financial industry. You know, thinking about changing culture sounds like motherhood and apple pie, and I'm not here to tell you that, you know, financial actors are bad and they need to be punished. Rather, I think we ought to start thinking more quantitatively about behavioral risk management. We think about financial risk management, we think about operational risk management. Why not think about behavioral risk management? And certainly the ideas that Kahneman, Tversky, and others have pioneered can now be used to start measuring behaviors in ways that we haven't before. And last but not least, I would suggest that we need to start thinking about engaging in forensic analysis of crises, creating the financial equivalent of the National Transportation Safety Board, collecting the black boxes, figuring out what happened, why it happened, how it happened, and what we can do to make sure it doesn't happen again. That's something that we do instinctively when an airplane goes down. That's not what we do when Bear Stearns or Lehman Brothers goes down. there are reports that were produced. For example, there was a bipartisan Financial Crisis Inquiry Commission that looked into the financial crisis. That bipartisan commission produced 3 mutually contradictory conclusions. 3. And so we still don't really know what happened. Imagine if the NTSB produced 3 mutually inconsistent conclusions about why TWA Flight 800 went down. That would get you a little worried, wouldn't it? And so all of these things are really meant to try to change the narrative about how to deal with financial crisis. And I want to end on this note. I want to talk about the idea, the power of narrative. What I mean by narrative is not just a collection of facts, but rather a story about how to interpret those facts. Because if you want to engage in systemic risk management, if you want people to cut back on an otherwise profitable and pleasurable activity, you need them to be taking pain. And in order for people to gladly take on pain, they have to either be doing that to avoid even greater pain or the threat of even greater pain in the future. And in order to do that, we need to provide that narrative. So I want to conclude with this example of an extraordinary story of pain. It has to do with a hiker named Aaron Lee Ralston, who in April of 2003 was hiking in a remote region of Utah, hundreds of miles away from civilization, no cell phone coverage, nobody around, and he was hiking by himself, and he slipped and fell down a crevasse, and a 600-pound boulder fell on top of him and pinned his right arm just below the elbow against the crevasse wall. And you probably remember that story because it was immortalized in this movie, 127 Hours, and in the book that Ralston published, Between a Rock and a Hard Place. You know what happened is after 5 days, he took out a multi-tool and cut off his right arm just below the elbow. How do you do that? How do you endure such enormous pain, especially after 5 days of very little water, no food, and just absolute, horrific thoughts? And so, obviously, we know how he did that. I won't tell you the gory details about how he went about doing that. But the way he motivated himself to do that is really the story here. And this is what he says in his book. A blonde 3-year-old boy in a red polo shirt comes running across a sunlit hardwood floor in what I somehow know is my future home. By the same intuitive perception, I know the boy is my own. I bend to scoop him into my left arm, using my handless right arm to balance him, and we laugh together as I swing him up to my shoulder. Then, with a shock, the vision blinks out. I'm back in the canyon, echoes of his joyful sounds resonating in my mind, creating a subconscious reassurance that somehow I will survive this entrapment. Despite having already come to accept that I will die where I stand before help arrives, now I believe I will live. That belief, that boy, changes everything for me. And the amazing thing about the story is that in 2003, Aaron Lee Ralston was not married, did not have a girlfriend, had no children. All of this was a narrative that came out of the figment of his imagination. It wasn't until 2009 that he got married, and in 2010, his little son Leo was born. 7 years later. And yet, that narrative gave him the motivation to cut off his right arm. We need new narratives in finance. And with the work that's being done here at PIIRS, and hopefully with collaborations that Simon and I and others will be able to entice you to engage in, we'll be able to do it together. Thank you.
I'm just going to talk for about 5 minutes. It's my job to comment on a lecture, and commenting on a lecture on systemic risk by Andy Lowe is not for the faint-hearted. Partly because in adaptive markets, he has the best academic takedown ever recorded. And let me just give you in a sense of what I have to live up to. The great analytical philosopher, J.L. Austin, had just given a great talk, an important talk, about only he could give, in which he claimed to have discovered a universal rule of language. This is that while a double negative was always a positive, a double positive never made a negative. understand this. To which, apparently someone who didn't like him very much, Sidney Morgenbesser, is reported to have said, yeah, yeah. So I can't top that. But with that in mind, I want to just question Andy on the dangers of metaphor, or the dangers of narrative, if you will. In his writing, and particularly in the work with Simon, he argues that we need a shift from physics paradigm to a more biological one for econ. That one should not be trying to identify three great rules of the universe, but rather empirically explore the complexity of evolutionary change in the various directions that it takes. He accuses economics, and I just love this, of theory envy, and a neglect of the study of ecological system of the economy. He suggests that economics should move from an efficient market hypothesis closer to what he calls an adaptive market hypothesis. Now, I agree with a lot of the critique of economics. Actually, because I was on the tenure committee, I actually got to see the average salaries in economics, so anything that critiques economics, I'm all for that. But I just want to just push you a little bit. And in a recent proceedings piece with Simon, you note that biological systems have evolved through adaptive, hierarchical, modular, and redundant solutions to challenges. So the first set of questions is, what's the equivalent in an economic system to modularity? So, just wait a second. I'll give you the, and what is the equivalent of redundancy in an economic system? So we can see that in an ecological system. What's the equivalent? What's the direct translation of this? You then say that there's four major lessons to be learned from evolution. One, uncontrolled growth is like a cancer. It's dangerous. Two, we need to develop adaptive regulations that will monitor environmental conditions. Three, feedback loops are an important homeostatic mechanism to prevent crisis. And four, we need to develop much more resilience and redundancy in the system so that horrific damages can be survived. So here are my questions based on those. First, what is the mechanism by which we can turn microprudential policies into macroprudential policies? Right now, the main regulation of the finance system is very microprudential. You watch out for the node. Is the node okay? Is an individual bank okay? Is an individual niche okay? People have argued that what we have to do is we have to shift to a more systemic, looking at the links or the edges between the nodes, and to try to understand that. Andre Haldane of the Bank of England has said he would like to have something like a captain's chair on the Starship Enterprise with screens sort of in front of him, showing all the various status of the system. The problem there is bounded rationality, which you talk about with Herb Simon. Wouldn't be a captain be seeing nothing but the algorithm of an algorithm of an algorithm of an algorithm? And if you're just seeing an algorithm of an algorithm of an algorithm of the system, how can you tell a real error from a false error? You know, the little red light is blinking, but you're not quite sure why. So how do you do microprudential watching, in a sense, when you have a problem of bounded rationality and complexity? Second, evolution is a really cold-hearted process. Species that no longer make it die. That's the way we get evolution. Are we willing to accept major species dying? Could we let a financial sector disappear? Could we let a region that's affected with a particularly virulent virus simply die behind a quarantine wall? Are we willing to go all the way with revolutionary logic to say, okay, this is what we're going to do. We're going to, it's the survival of the fittest. Third, evolution has no individuals attempting to exert their agency against it. How do we manage the same process with human actors? Species aren't aware of their own fate, in a sense. Individual humans are. You talk about the possibility of group selection accompanying kin selection, following lots of work by Wilson, etc. How do you play that out in an economy? Isn't a trust or a monopoly a perfect example of a group select process? I mean, that's what you do. You get together and you stop competing against each other. So and I love the book, and I'm totally agreeing with it, but I still want to push it, that the economy should be thought of an ecosystem with failure and success in a perpetually adaptive environment. Isn't that an argument for just absolute capitalism? Isn't that an argument, in a sense, for just getting rid of regulation? And if you accept the parts of your book where you talk about complexity, aren't you basically bringing back the Hayek idea that this box is so complicated that any attempt to regulate it is going to produce problems? So you have to let the box go. You don't want to play with evolution. You simply have to just let this box and this financial system be, because you won't be able to control it. And with that.
Okay, just a couple of small questions, I guess. Where to begin?
Yeah, would be it.
Yeah, exactly. So let me maybe start with your last question first, and answer the question about should we just forget about regulation because it's hopelessly complex and let the system evolve naturally. I think the answer is clearly no. And the reason is because we actually have the capacity to change our destiny. Unlike many species that don't think ahead, we actually have the ability to engage in abstract thought and engage in what I call evolution at the speed of thought. We can actually hold in our minds 25 different futures, and we can decide which one we want and say that one is the one we want. Whether it's going to dinner, or saving money for your children to go to school, or changing the way banks are structured to prevent these kinds of financial crises from occurring. So we have that ability, and that means we can use it. But it doesn't mean that it's going to be easy, because at the same time that we have the ability to hold these abstract thoughts in our head, the system is getting a lot more complicated. And so I think you made the point earlier that we're not talking about species that engage in some relatively simple sets of activities. We respond to changes in our environment. And by the way, many species do that as well, as we can see biologically, but our responses can be quite a bit more complex and refined. That means that we have to be that much more complex and refined in how we craft our regulations. And I think that's maybe what's missing. It's that we're not thinking of the system as a system. And maybe that's the nature of how regulation had to be in the 1930s, 40s, and 50s, where a lot of our financial regulations emerged. In other words, we were siloed back then because it made sense, since there was relatively little interaction across these kinds of markets. But that's not true today. And we see that because routinely we have dislocation in one market spreading to other markets. The flash crash being just one case in point, but there are many others. And so what I think needs to happen today is for us to acknowledge that we are now dealing with the system, and we have to start managing it as a system. We're starting to try to do that. So the Dodd-Frank Act called for the creation of the so-called Financial Stability Oversight Council. That's basically a college of regulators that get together once a quarter to talk about systemic risk issues. The problem is that that is not a super regulator. The FSOC doesn't have authority unilaterally to change laws and rules in various different parts of the financial system. They have to get the appropriate regulators that are responsible for that particular silo to do so. And so we're a bit a ways from that kind of systemic regulation. If we get there, we can then start dealing with issues of resilience, modularity, and robustness. And I think I can collapse all of those terms into one simple idea that evolutionary biologists have been proposing for quite some time now, which is biodiversity. At first, it intrigued me as to why it is that evolutionary biologists thought that it would be useful to have lots of different species. Why not just focus on the ones that work well in this current environment and forget about the rest? And the answer, of course, is when you have stochastic environments, when they change over time, what is useful in one environment may not be so useful in another environment. And so having biodiversity is a key concept that we don't think as much of in standard economics. We could, there's nothing that says that economists shouldn't be focusing on that, but if we started to do that, then these principles of modularity, resilience, robustness then become much more important and relevant.
Yes. Why don't you choose your interrogators?
I'm not coming in. I want to characterize your talk as having two parts. I want to ask about the relationship between, it's a part, of course, there's a lot of different ways first part argued that adverse adaptation takes place. By adverse adaptation, I mean adaptation that nullifies the effect of the regulation. Peltzman's an example of that. Adverse adaptation to car safety regulation. And part two argued that we should worry about financial risk and devise metrics to anticipate crises and regulate accordingly. And what I want to know is, have you analyzed which of these types of regulation will generate adverse adaptation and which ones won't? Because the ones that generate adverse adaptation will be nullified by the adaptation. The other ones will not. It would seem crucial to know that answer that question.
Right. So there's a simple answer that is much, much more complicated to put into practice. The simple answer is, it's one that actually economists, I think, were among the first to point out, which is that individuals, human individuals, are sneaky little bastards. They tend to take advantage of all sorts of loopholes if they're there. And so the way that you deal with that kind of behavior is to anticipate it and to design regulation that would ultimately be immune to it. Now that's easier said than done, but that's the ultimate principle, is to acknowledge that individuals are going to try to get around regulation. And so can you craft regulation that isn't going to be possible to circumvent? And in many cases, it's going to require a lot more effort than we're putting into the regulations. It's not going to be just a simple Band-Aid to say, you're doing this, stop doing it, and we're going to put a rule that says you can't do any more of it from this point forward. It means creating more complex dynamic regulation. And do I have an example? I have a very simple example that works in a very narrow context. The way that we manage leverage in certain markets is actually quite effective, because what we say to, for example, when you have a brokerage account, if you're an institution, you can have a certain amount of borrowing from your creditor, the brokerage firm. And typically that amount of leverage varies as a function of market conditions. So on many exchanges, what they will do is change the amount of leverage that you can use in a contract based upon the current market volatility. They provide that formula to the marketplace. The marketplace understands how that formula is calculated, and they make sure that when they calculate your leverage, they aggregate all of the various different accounts at that brokerage firm, and they require you to disclose leverage at other firms so that you're actually centralizing all of your leverage in that one calculation. Because they know that if they give you the rule focused just on this one account, you can easily start up another account and get around it. So that's an example where in the futures markets, there hasn't been a futures market brokerage firm collapse in decades because they've been able to manage that kind of leverage very effectively. That approach is not being used at banks. Banks have a different system for calculating the amount of leverage. It's based upon accounting of book value as opposed to daily market value. So that's an example where if you anticipate people's behavior and their response to regulation, you might be able to devise a more sophisticated regulation that will anticipate it and therefore make it robust. Simon?
So I have two questions that are somewhat related to each other. The first is, you said that one of the things we need are negative feedbacks, and that was uncontroversial. But the picture you showed of our paper has this cartoon sort of not exactly the Tacoma Narrows Bridge, in which really strong negative feedbacks can be destabilizing, and we have lots of examples in our paper. So it seems maybe that is controversial. And the second question is actually more of a point, is that we have really a hypothesis, but a research agenda in our group, which is that critical transitions of systems are often associated with reduction of dimensionality of those systems. And it seems to me that that's actually what's happening when the correlation coefficient, which previously was low, for unpredictable reasons becomes large, then the system is operating like a single entity. And so we should really be looking at those, that we've been looking for data, and I should have thought, but we'll be in touch on that one. But, so.
Yeah, absolutely. And I think we have to be looking at that across a lot of different institutions that normally might not be at all related, but in certain contexts, in certain environments, they can actually become, they can phase lock, in which case
Exactly.
we get some pretty serious repercussions. Yes.
So wait, you didn't answer the question about the feedback loops, though. did you?
Yeah, so I would suggest that there is controversy as to the degree of negative feedback you want. But I don't think there's any controversy that you need negative feedback.
You need
And-
timely feedback. You should put the word timely on the slide.
Yes.
Because delayed feedback is bad, so you need to say timely.
In fact, Simon and I have a project where we show that a small delay in how you impose these constraints can lead to cycles that will never end, which is exactly right. So yes, timely feedback, but it also has to be calibrated to be the right amount of feedback. And so
Right.
I don't think it's controversial that we need negative
No, I-
feedback.
I
What's
agree.
controversial is how to time it and how to gauge it so that it's just the right amount. Because too much and you go overboard, you can actually kill economic growth. Too little and you can get bubbles that explode. So what is just the right amount? That's hard to do. Yes.
Thanks for a very interesting seminar. I'm wondering if I could try to ask you about what your deeper goal is here. And I can understand using ecological analogies to describe a system, and there are many different ways to describe a system. But the other, and what I think I get from your presentation is that there's maybe a deeper issue of trying to understand so that you can manage the system better. Now, natural systems have flash crashes, they have micro crashes, they have macro crashes, they have all of the dynamics that you see. So in your presentation, it was very compelling, but I was asking myself this question. Do you have any evidence that actually links any of the crashes or any of the stability measures or patterns to a perspective that is enhanced by taking to a theory that is enhanced by taking a kind of an ecological or ecosystem or evolutionary perspective as opposed to just a stem? In other words, what's the evidence for causality as opposed to description?
Right. So let me answer the first part of that question first, which has to do with this analogy. I actually don't look at evolutionary biology as an analogy to what's happening in the economy. I actually look at it as a direct application of evolutionary biology. So in other words, it is literally the principles of selection that's occurring in the marketplace day by day. It may not be biological selection, but it is nonetheless selection. It's the survival of the richest, if you will. And so when I think about all of the principles that I've learned from Simon and other evolutionary biologists, I'm actually thinking about these principles as ways of managing an otherwise very difficult to manage system. Because we have not been successful in managing it using economic models. And so something's missing. What I think is missing is the fact that we're dealing with an organic system, not a mechanical system, and that the laws of motion change over time and is a function of circumstances and the environment. So what am I hoping to get out of it? I'm hoping to get out of it using these principles that will lead us to better regulation. And what I mean by better is regulation that provides more stable and more predictable economic growth and less of the ups and less of the downs. So in other words, to try to reduce the fluctuations in the same way that homeostasis is really meant to reduce the fluctuations. Why do we want to reduce the fluctuations in the pH in our blood? Presumably, a more stable environment actually allows growth to happen more readily. So my goal is the perpetuation of our species. And I think this might actually help us do that.
Can you speak to the question of evidence just?
Oh, so what is the evidence? Well, first, I would argue that I'm not sure that there is any evidence yet because this is an approach that Simon and I and others have been espousing relatively recently. So it hasn't actually been implemented. What I use as evidence, though, is if you take a look at the kinds of financial crises that we've observed, we see them happening in the case of the flash crashes more frequently. So that's a new part of our ecosystem. It didn't exist 10 years ago. It exists now. And so that's an example of something new that's happened because of financial innovation. To me, that's evidence that these principles of selection, competition, innovation, and ultimately evolution, that they are relevant. But I don't have any evidence that we can actually do something about it.
I'm sorry, we have a class here at 6, so one last question, and we have
Brian Grenfell. I work on infectious disease dynamics. I mean, great overall, but I worry a little bit about bringing up the immune system. It's very different in lots of ways. Most of the time, we're trying to damp down our immune systems and positive feedbacks. So I think, probably too long an answer to. Do you have a specific analogy with the immune system, or is it more general?
The idea behind the immune system was to figure out a way for the financial system to correct itself by essentially dealing with some of the threats on a relatively automated basis. So for example, when you see banks that have become too big to fail, are there ways to challenge their growth by introducing the equivalent of T cells that would ultimately, rein them back?
I wonder whether physiological homeostasis is a better analogy.
That's certainly a possibility. But,
I'm sorry,
yeah.
I have just
Sure.
been told that it's not a class, it's an exam. So we have to
On that
leave here.
note,
Thank you so
thank you
much.
very much. Thank you.